Hey ADPI Nation, Mark Yancich here with Active Duty Passive Income. And in this video, we're gonna be talking about the 5 reasons why a 30-year mortgage is better than a 15-year mortgage as an investment or for investors. Now, I'm not saying that one is better than the other. What I'm saying is from a cash flow, buy and hold investment perspective, these are the 5 reasons why a 30-year mortgage is better than a 15-year mortgage. Do whatever you want, but this is how we look at it from that perspective, through that lens, through a buy and hold for cash flow lens. Now make sure you watch till the end because understanding these 5 reasons will really help you scale your portfolio of rentals and increase your cash flow. If this is your first time watching any of our videos and you haven't subscribed yet, make sure you hit the subscribe button, the like button, and the little bell notification because these videos are only getting better and better. Our mission is to help military members achieve financial freedom through real estate investing and entrepreneurship. So tune in to all of our videos by subscribing. All right, let's kick it. Reason number 1 is debt to income ratio. Most lenders or most loan products will look at debt to income ratio. So when they look at you as a borrower, they're like, okay, how much money you're making? How much money do you have to spend every single month? And that ratio is what they look at to determine whether they want to give you a loan or how much of a loan they want to give you. Obviously, they never want your debt payments to be more than your income. And in fact, they want your debt payments to be as low as possible compared to your income. And so that ratio is critical. If you do a 30-year loan, guess what? Your payments are lower. And so now your debt to income ratio is lower. And so what does that mean? If you think about the future and if you want to scale, if you want to acquire more rentals, if you buy a rental property and it keeps your debt to income manageable, that means you'll be able to qualify for the next one easier or faster. So that's what you got to think about. Reason number 2 is it keeps more cash in your pocket. If you have to pay less on your mortgage every single month, that's actually pretty awesome because now you are more agile as an investor. Now you retain more cash that you earned that month and you're able to maybe invest it in other opportunities. What's to say that this one opportunity that you bought, like this rental property, for example, what's to say that it won't pan out quite as well as you would like? Or maybe there's something that pops up that's even more amazing, even if this one's already awesome. Everybody talks about, hey, you need to be able to diversify your investments. Well, if all of your money is constantly flowing or being spent on upkeeping or investing in one asset, then you don't have that much to diversify in the first place. So keep that in mind. If you can keep more cash in your pocket while still acquiring cash flowing assets, that's the way to go in my opinion. Reason number 3, and this one's a big one, it's higher cash flow. If you think about it, this might sound redundant, but it makes sense. If you have a rental property and you get to pay less on it every single month, that means every single month, the amount that remains, right, the cash flow, is going to be greater. And the reason why real estate investors love cash flow so much is because if you set it up right, it's more or less passive income, right? If you have all your systems in place and you have a good property manager and you vet your tenants well and it's a good market and all those things that we teach at Active Duty Passive Income, if all that's set up, then your cash flow is basically more or less passive. And the more passive income you create for yourself, the quicker you can be free financially and do whatever you want. So higher cash flow per property is a good thing. Reason number 4 is flexibility. Guess what? Just because you have a 30-year mortgage doesn't mean you can't pay it off in 15 years. And the interest rate is actually not that different. It is almost negligible if you weigh the amount of flexibility that a 30-year loan gives you. When you purchase a 30-year loan, if you really want to pay it off in 15 years or less, you can literally go into your mortgage servicer's login portal and you can set up extra money to go towards the principal balance, the paying off the principal balance of your loan, right? And that's it. That's all you have to do. And it'll kind of recalculate your schedule and how long it'll take to pay off. And you'll see it happening every single month. And it's that simple. So why pigeonhole yourself? Why put yourself between a rock and a hard place and get a 15-year loan if you can do a 30-year loan and still achieve the exact same results? You pay a little bit more in interest rates sometimes, but the flexibility is paramount here in my opinion. Again, I want to be an agile investor. I want to be able to see opportunities and maybe pounce on them when they come my way if I want to, right? So that flexibility is critical for me personally. And last but not least, reason number 5 is you can qualify for a bigger mortgage, i.e. a bigger property. And this is critical. I mean, if you're house hacking, for example, you could potentially get a 4-plex that's really nice and really big, afford a potentially multi-million-dollar primary residence and rent out other homes in that residential property, that's a big deal. Another way to look at it is also it's good to be able to get a bigger mortgage if you ever want to buy a forever home. I mean, I live pretty frugally right now with my family, right? We're not getting any kind of mansions anytime soon because I'm still in that capital building, cash flow growing phase. But soon I might want to buy a really nice forever home. And if I do, it's nice to have a lower debt to income ratio. It's nice to have more cash flow because it'll help me get a bigger property, not only because that property, that forever home will be a 30-year loan, but because I've been getting 30-year loans the whole time. So lots to think about when you're growing your portfolio. But I think the bottom line is, as buy and hold cash flow real estate investors at Active Duty Passive Income, we believe that you want to keep your debt to income ratio down and you want to keep your cash flow up. You want to grow that scoreboard. Like our main scoreboard isn't how much equity we have potentially, at least me, okay? I'm not going to speak for the rest of my team, but this is the general philosophy of our community is like the scoreboard isn't necessarily how much equity I've captured in however many units in real estate I have. It's how much cash flow is all this producing me? That's my scoreboard. That's what I want to grow every single acquisition. And every single year when the rents go up, I want that to grow and grow and grow. That's what we care about. And that's why I think this topic is important. It is important to understand why a 30-year loan can significantly help you scale your portfolio and grow your cash flow. Again, this is Mark Yancich. Thank you so much for watching this video. If you liked it, subscribe. If you really want to support us, share this on any of your social media. Thank you so much. I'll talk to you guys later. Bye.